Welcome to the deep dive. Today we're plunging into a fascinating, maybe even a bit contentious question.
Oh,
Can a single software platform really become the indispensable operating system for the world's most sophisticated investors?
okay. That's a big one.
And maybe more critically, what happens when expert models, looking at the exact same company, come to wildly different conclusions about its intrinsic value?
Indeed. We're talking about Clearwater Analytics Holdings, Inc., ticker CWAN.
Right.
As of, well, today, July 26, 2025, it's trading around $21.30. They're a significant player in the financial tech space.
Definitely.
And our mission today is really to give you, our listener, a shortcut, a way to get truly well-informed.
Yeah, we're pulling out the most important nuggets of knowledge, the key insights from an in-depth report we've been digging into.
Exactly. Complete with, some surprising facts and hopefully an engaging discussion about their business model, leadership, financials, market buzz, who owns the stock, and of course the big risks.
Okay, we've set the stage. Let's unlock the story of Clearwater. We'll start with the foundation, right? The core business, the team, and their financial health.
Business analysis, the digital ledger for global investment.
So let's start with that core business, Clearwater Analytics. They operate on a classic SaaS model, right? Software as a service.
That's it. Which means, they generate highly predictable recurring revenue.
Okay. And how does that work primarily?
It's mainly through subscription fees, and these are based on the assets on platform, or AOP, that their clients manage.
AOP, got it. And we're talking significant numbers here.
Oh yeah, we're not talking small potatoes. It's $8.8 trillion in AOP managed for over 1,200 organizations around the globe.
Wow, trillion.
Right. And this AOP-based model, it's not just about predictable revenue. It fundamentally aligns Clearwater's success with the growth of global assets.
So market tailwinds become their tailwinds.
Pretty much, yeah. It turns that directly into their own revenue expansion. What's really smart, though, is how they restructured their contracts back in 2022.
What did they do?
Well, it was designed to add resilience. So even if client assets under management, AUM, dip a bit.
Like in a downturn.
Exactly. Clearwater's revenue doesn't fall quite as sharply, but they still capture nearly all the upside when things boom. It's subtle, but it's a critical protection layer.
Makes sense. And the platform itself.
At its core, it's a comprehensive cloud-native platform. It automates the entire investment lifecycle, basically getting rid of those traditional info silos that plague the older systems.
Okay, and they have specific modules.
Yeah, think Clearwater Prism for data warehousing reporting, Clearwater LPX, that's specialized for private funds.
Which are notoriously complex.
Oh, yeah. And Clearwater MLX for mortgage loans, basically dedicated engines handling the unique, often kind of opaque accounting for these complex assets. They ensure precision where legacy systems often, fall apart.
So this isn't just a back office tool anymore, is it?
Not at all. Clearwater is strategically evolving. They want to be a complete operating system for investment management.
And acquisitions are key to that, like GMP Technologies, and more recently, Infusion.
Absolutely. Infusion was a big one, adding crucial front office capabilities. Think order and portfolio management systems, OMS, PMS.
Right. So that puts them up against the big guns like BlackRock's Aladdin or SimCorp Dimension. What's their edge there?
It really comes down to their modern cloud-native architecture. A lot of rivals are kind of burdened with these stitched-together legacy systems.
Patchwork quilts, basically.
Kind of, yeah. Clearwater was built from the ground up, cloud-native. That lets them innovate faster, and they boast these really impressive 80% win rates for new business.
80%? Wow.
It's strong. Now, looking at their market position, their scale, Clearwater's market cap is around $6.0 billion.
Mid-cap territory.
Right. And despite that huge $8.8 trillion AOP, management estimates the global addressable market, the TAM for their kind of solutions, is about $10 billion a year.
Okay, so where does Clearwater sit in that?
Well, with their trailing 12-month revenue around $476 million, they currently capture less than 5% of that TAM.
So huge runway for growth still.
Immense untapped potential, yeah. And if you zoom out even further, this broader investment accounting as a service market, it's projected to grow at a compound annual growth rate of like 32.3%.
32% CAGR.
Yeah, potentially hitting $465 billion by 2030. It just underscores these powerful secular tailwinds pushing the whole industry forward.
So Clearwater's a decent-sized fish in a rapidly expanding ocean. But, okay, bring it back down to the client level. What's the main value proposition for them day to day?
It's really about replacing those fragmented, inefficient legacy systems, the patchwork quilt we mentioned.
Right.
They swap that out for a single, unified, cloud-native platform. For these big institutional investors, often stuck with old software, Clearwater delivers what they call a single source of truth.
The golden copy.
Exactly, the golden copy of investment data. It's automatically aggregated, reconciled, validated daily.
That simplifies things, reduces manual work.
It does, and it speeds up financial closes from weeks down to days sometimes. But the deeper insight, I think, is that Clearwater sells certainty.
Certainty. How so?
Well, in a world with more and more regulation, tons of data, having that golden copy isn't just convenient. It's actually an existential risk reduction strategy for these firms.
Oh, okay, that makes sense.
And that's why their gross revenue retention rates are so high, consistently 98% or above. Clients just, they don't leave.
That's incredibly sticky. So looking at the industry, Clearwater seems perfectly positioned, doesn't it? You've got digital transformation, demand for real-time data, outsourcing trends, increasing regulatory complexity.
Exactly. They're right at the confluence of these powerful, multi-decade secular trends. These aren't just cyclical shifts, they're fundamental changes driving long-term growth.
And the competitors. You mentioned the big ones, SS&C, State Street, SimCorp, BlackRock, plus internal IT trying to do it themselves.
Right. But Clearwater's biggest advantage, as we said, is that modern single-instance multi-tenant SaaS architecture. It just allows for faster innovation compared to rivals trying to patch up legacy systems. That fuels the 80% win rate.
And the regulations actually help them.
Absolutely. The increasingly complex environment, SEC rules, Form 13F, Form SHO, multi-basis accounting, ESG reporting, it all acts as a significant and recurring tailwind. It pushes more firms towards automated single-source solutions just to stay compliant.
Okay, let's talk about their competitive advantages, their moat. Brand strength has to be one, right?
Yeah.
Especially in finance.
Definitely. Reputation is everything. Clearwater's seen as industry-leading. They've got a blue-chip client list, strategic partnerships with huge names like Bloomberg, BNP Paribas. That builds credibility.
And the cost advantages, economies of scale.
Yeah, that single-instance multi-tenant setup means most costs are fixed. So as they add more clients, more AOP, those fixed costs get spread wider.
Which leads to margin expansion.
Right. Naturally. That's why you see those consistent 70-75% gross margins. It's a sign of a superior business model.
And the moat gets deeper with network effects and switching costs.
Hugely. The platform gets deeply embedded in client workflows, moving trillions of dollars of data. It's a multi-year, multi-million-dollar headache. Massive operational risk.
So immense switching costs.
Exactly. Which explains that 98% plus gross retention. But what's really cool is the data network effect. Every new client actually enriches Clearwater's central security master. It has over 4 million instruments now.
So adding clients makes the system better for all clients.
Precisely. It improves accuracy, speed. It's a self-reinforcing loop. And lastly, their unique asset really is that modern unified architecture. Competitors can buy features, sure, but integrating them onto old systems, that's a massive challenge.
So the acquisitions like Infusion and Beacon, once integrated, create something very hard to replicate.
Very hard for incumbents to match, yeah. An end-to-end offering on a modern foundation.
Management evaluation, architects of a front-to-back vision.
Okay, now let's talk about the people running the show. Leadership quality is obviously crucial for any long-term investment.
Absolutely. And Clearwater's team looks pretty seasoned. They have deep domain-specific expertise.
The CEO, Sandeep Sahai, he's been there since 2018, led the IPO in 21.
That's right. His background includes being CEO of Headstrong, a financial services tech provider, and he was an operating partner at a PE firm. So suggests a focus on operational excellence, value creation.
And the CFO, Jim Cox, he joined in 2019. But his background is interesting, right? He was CFO of Advent Software, a direct competitor.
Yeah, and that's actually an invaluable asset.
How so?
Well, having a CFO with direct experience at a key competitor, that gives you unparalleled competitive intelligence, deep insight into market dynamics. It's a rare strategic edge.
Interesting perspective.
And the broader exec team is really well credentialed too. People from Goldman Sachs, Boston Consulting Group, Zenefits. This kind of expertise increases the odds of successful execution, especially with these complex M&A integrations they're doing.
And how are they on communication? Transparency.
Pretty good, actually. They provide detailed financial results, ARR, NRR, GRR. They're active at conferences, investor days, seem willing to discuss challenges, And importantly, we found no evidence of any major ethical scandals. Always a plus.
Okay, let's talk capital allocation. Their strategy seems pretty focused right now.
Yeah, you could say single-minded. It's all about accelerating this transformation into a dominant end-to-end investment management platform. And they're doing it through aggressive M&A.
It sounds high stakes, high reward, potentially high risk.
It is. They made some huge moves just this year, 2025. Acquired Infusion for $1.5 billion that added the front and middle office stuff.
Right.
Then Beacon Platform for $560 million that brought in sophisticated modeling, risk analytics, and Blackstone's Bistro for $125 million, an in-house visualization tool.
How'd they pay for all that?
Combination of cash and an $800 million term loan B. It really is a land grab strategy.
But isn't that aggressive approach exactly where the bear case comes in? The sheer scale, integrating all that simultaneously, that must carry immense risk.
Absolutely, and that's the critical tension, isn't it? Sahai and his team have this clear vision, but the execution risk is huge. This is where bullish conviction really gets tested.
And besides M&A, they're still investing internally.
Oh yeah, heavily, in organic R&D. The CEO mentioned about 60% of their R&D capacity is focused on building new products, often partnering directly with clients.
Okay. And shareholder returns? Dividends, buybacks?
Nope. No dividend, no formal share buyback program, which basically signals management thinks they have plenty of high-return ways to reinvest that capital right back into the business itself.
Right. And return on invested capital, ROIC, how does that look historically?
Well, historically, the figures are actually pretty inconsistent and kind of unrepresentative for Clearwater.
Why is that?
Mostly because of a one-time, non-cash, $472 million income tax benefit they got in Q4 2024. It massively skewed things.
Right.
Plus, for a high-growth size company like this, GAAP net income, it often gets distorted by non-cash items, heavy reinvestment. Revenue and free cash flow are much more reliable indicators of core business health.
So if historical ROIC is kind of useless here, what should investors be focused on regarding their capital allocation?
That's exactly it. The critical question for you as an investor isn't the backward-looking ROIC. It's entirely about the forward-looking return. What return will management generate on the capital they just poured into Infusion, Beacon, and Bistro?
The success of those integrations.
That's the ultimate determinant of their capital allocation skill.
Financial analysis, a story of growth and stability.
All right, let's move into the financials, the numbers. And this is where we see that history of, well, pretty durable growth, attractive profitability, and a strong financial position.
Yeah, it really looks like Clearwater hit a critical inflection point recently, moving from, a cash-consuming growth company to a scalable enterprise that's actually generating significant free cash flow.
Okay, let's break down the key metrics. Market cap.
Around $6 billion, puts it firmly in the mid-cap segment.
And revenue growth.
Remarkable, really. Consistent 20-24% annual growth over the past 5 fiscal years. Went from $168 million in 2019 up to $452 million in 2024. TTM revenue is now $476 million.
And that consistency held up even through different economic climates.
It did, yeah, which really speaks to the sort of non-discretionary nature of their services. Clients need this stuff.
Right, profit margins.
Gross margins are consistently high and stable, 71-74%. That really highlights the profitability, the scalability of that SaaS model.
Operating margins.
A bit more volatile, but that reflects their deliberate investments in growth, R&D, sales, and marketing.
And net margin. I remember you mentioned something weird there.
Yeah, here's a crucial point. That TTM net margin of 90.13%. It's completely anomalous. You really have to disregard it.
Because of that one-time tax benefit.
Exactly. The $472 million non-cash tax benefit. A much better indicator of their underlying profitability is the TTM free cash flow margin. That's running at 17.54%.
Okay, 17.5%. And the free cash flow generation itself?
Explosive, just explosive growth. They generated $83.5 million in TTM free cash flow. Year-over-year growth was 117% in Q2 24 and 168% in Q1 25.
Wow. So that transition to generating cash is real.
Oh, yeah. And it's not just a financial milestone. It dramatically strengthens their financial footing, gives them much more flexibility, resilience.
What about earnings consistency? CAP EPS?
Well, CAP EPS has been inconsistent, mostly negative, actually. Partly due to IPO timing, non-cash expenses. Again, not the best indicator here. The consistent revenue growth and that rapidly growing free cash flow, far more reliable signal.
Got it. Financial stability Debt.
Historically, their balance sheet was very conservative, very low debt-to-equity ratio, like 0.06, just 6% before the recent acquisitions, and they had a strong net cash position.
But the acquisitions added debt.
They did, with that $800 term loan. But management expects the pro forma net leverage to stay under 3.0x EBITDA, which is generally considered manageable.
In short-term liquidity.
Exceptionally strong. Current ratio is 5.09. That indicates an overwhelming capacity to meet all their short-term obligations. No worries there.
And no dividend, as we said. Consistent with the growth strategy.
Exactly.
Okay, valuation analysis, price to earnings.
Well, the TTM-PE is misleading, again, because of the tax benefit. The forward PZ is more meaningful. That's around 35.7x.
How does that stack up against peers?
Compared to peers like Q2 Holdings at 40.8x or Vertex at 56.7x. Clearwater actually appears reasonably valued, maybe even reflects a bit of a discount because of that M&A integration risk we keep talking about.
Right, and intrinsic value, DCF.
Yeah, we also looked at discounted cash flow models.
Yeah.
DCF basically tries to value an asset based on its future cash flows discounted back to today's value.
It's rigorous, forward-looking.
Right. But its biggest weakness is it's super sensitive to the assumptions you plug in.
And that sensitivity really showed up here, didn't it?
It really did. Perfectly illustrated by the, starkly different conclusions from the educational DCF models we reviewed.
What did they show?
Well, a bullish model from Simply Walsain calculated a fair value of $42.35 per share. Conclusion: Clearwater is quite undervalued.
Okay.
But then a more bearish model from Alpha Spread arrived at just $9.38 per share. Conclusion: overvalued by 56%.
Wow. From $9 to $42, that's a massive divergence.
Huge. It really highlights that there's no single correct DCF value. It all depends on your inputs.
And what were the key assumptions driving that difference?
It boiled down to a couple of things. The bullish model used a lower discount rate, 7.7%, and assumed a longer 10-year high-growth period.
Makes sense. More optimistic assumptions.
Right. The bearish model used a higher discount rate, 8.56%, and a shorter 5-year forecast period. So ultimately, your own assessment of those variables, the discount rate, the growth duration, that's what will determine your conclusion on value.
All right, let's transition. That wraps up the fundamentals. Now let's shift gears into the second part of our deep dive. Here we'll explore how the broader market views Clearwater Analytics, who owns the stock, and those critical risks and opportunities ahead.
Market sentiment.
Okay, market perception. How does Wall Street see CWAN?
Well, there's a pretty strong bullish consensus among the analysts who cover it.
Really? Like buy ratings?
Yeah, a strong buy consensus rating. It's based on 9 buy ratings, 2 holds, and 0 sells.
0 sells. Interesting. And price targets?
The average 12-month price target is $31.80. Compared to the current price, around $21.80, that's roughly 50% potential upside.
50%. That's quite optimistic. What's the range on those targets?
Ranges from $26 on the low end up to $36 on the high end. So even the lowest target implies decent upside.
But doesn't Zacks have a different view?
It does, yeah. And this is an interesting contrast. Zacks' quantitative system actually assigns Clearwater a sell rating.
A sell. Why the difference?
Primarily due to poor scores on their value and growth factors, although interestingly, it does score high on momentum.
So quantitative models see it differently than analysts.
Often happens. Quants are typically backward-looking, right? They might not fully capture the qualitative strengths or, crucially, the future impacts of those big strategic acquisitions that analysts are actively building into their forward-looking models.
Makes sense.
Yeah.
What about recent news flow? Media tone?
Overwhelmingly positive, actually. There's been a steady stream of high-profile client wins, McCormick & Company, Germany's Versicherung scammer, Poolry.
Big names.
Yeah. Plus positive coverage of the strategic stuff, the Bloomberg partnership, the Infusion and Beacon acquisitions. They've even got a second investor day coming up soon. So the general media tone is definitely favorable, focusing on growth and strategy.
Okay. But what about market indicators? Like short interest. Are people betting against it?
There is some short interest, yeah. It's moderate, maybe around 5.1% of the float. That's about 12.9 million shares shorted. Takes about 3.5 days to cover based on average volume.
So not insignificant.
No, it indicates a material group of investors betting against the stock, likely due to those valuation concerns or the M&A integration risk we keep highlighting.
And technically, how does this chart look?
Technically, it looks weak right now. The stock price, $21.30, is trading below both its 50-day simple moving average, which is around $22.79,
Okay.
and its 200-day simple moving average, which is up at $26.24.
So below both short-term and long-term trend indicators,
Yeah.
downtrends.
Exactly, which creates this, well, interesting divergence, doesn't it?
Yeah, technical weakness versus positive fundamentals and analyst ratings. What does that suggest to you?
It suggests that while the long-term fundamental story might be compelling for many, there's current market apprehension. Could be valuation, could be nervousness about the integration. For a value-oriented investor,
This
though,
could be an opportunity.
could be, yeah. An opportunity to potentially buy a high-quality business at a more attractive price if your conviction in the long-term thesis holds up and you think the current market worry is maybe overblown or temporary.
Ownership structure.
Okay, let's dig into who actually owns Clearwater, the ownership structure.
Right. First thing to note is the institutional ownership. It's very high. Actually represents over 100% of the shares outstanding if you account for certain ways of counting.
Which is strong validation from professional money manager.
Absolutely. Top holders are the usual suspects, big institutions, Vanguard Group, BlackRock, FTV Management Company, Kane Anderson Rudnick, Wasatch Advisors.
Any interesting trends there, buying or selling?
Mixed, actually. The big passive managers like Vanguard and BlackRock seem to have increased their positions, which often happens as companies grow. But some of the active managers have actually trimmed their stakes recently.
What about insiders, management ownership?
That's actually relatively low, somewhere between 2.0% and 3.3% insider ownership.
2 to 3%. That does seem low for a tech company.
It is. And maybe more telling, if you look at recent insider transactions, there's a pretty consistent pattern of selling.
Selling. By who?
Well, for example, CEO Sandeep Sahai sold about $356,000 worth of shares back in June 2025. CFO James Cox sold around $421,000 worth in July 2025. Total insider sales recently have been around $5.8 million.
And any open market purchases by insiders?
No, that's the key. Consistent selling, no buying.
That feels like, well, a bearish data point, doesn't it?
It certainly often gives investors pause. Now, these sales can be for personal financial planning reasons, diversification, taxes, buying a house, whatever.
Sure.
But the consistent pattern, especially with no buying, could also imply that those closest to the company with the most intimate knowledge.
Like the stock is fairly valued, or maybe they're de-risking ahead of those big M&A challenges.
Exactly. It could be seen as an implicit acknowledgement of the significant execution risks ahead, even if they believe in the long-term vision.
Right. What about ownership concentration among institutions?
It's reasonable. The top 10 institutional holders control about 36% of all the institutional holdings.
So fairly stable, but not overly concentrated.
Right. Provides a stable base, but also carries some risk if one or two of those key holders were to change their sentiment and sell a large block.
Risk assessment.
Okay, we've talked a lot about the growth story, the potential, but with great opportunity comes great risk, right? Let's focus on the vulnerabilities. What keeps a Clearwater bull awake at night?
Well, we've touched on it a lot, but it bears repeating. The biggest risk, the core of the bear case really, is that M&A integration.
Integrating Infusion, Beacon, and Bistro all at once.
Exactly. The sheer scale, the operational complexity, the cultural integration. It's immense. That's their biggest weakness right now, the core execution risk. If they stumble here...
It could lead to disruption, loss of focus.
Yeah, and potentially value destruction. That's the big one.
But that's the key weakness. Yeah. Strengths, we covered the architecture, switching costs, brand.
Right. Opportunities. Huge potential to cross-sell those new front office products into their existing client base. Keep displacing legacy competitors, expand internationally, and ride those big secular trends, digitization, outsourcing, regulation.
And threats. Besides the integration risk.
Intense competition, obviously. From large, well-resourced incumbents like BlackRock, SS&C, there's always the risk of a macroeconomic downturn compressing client AUM.
Although those restructured contracts help mitigate that a bit.
They do, partially. Rising interest rates are a threat, especially for growth stock valuations. And, you know, general geopolitical instability could always ripple through financial markets.
Let's talk about those macro factors, interest rates specifically. How do rising rates impact a company like Clearwater?
Well, as a high-growth tech company, its valuation is particularly sensitive to rising long-term interest rates. It's pretty straightforward finance theory.
How so?
When the risk-free rate goes up, the discount rate that investors use to value future cash flows also goes up. And since a lot of a growth stock's value is tied to cash flows expected far out in the future,
discounting them back at a higher rate reduces their present value.
Exactly. It inherently puts downward pressure on the intrinsic value calculation for growth stocks.
Got it. And geopolitical factors. You mentioned things like tariffs. How could that impact a software company?
Yeah, it's usually indirect. Clearwater isn't directly hit by, say, specific U.S. tariffs on goods from China in 2025, but broader geopolitical disruptions, like if widespread tariffs were to trigger a global economic slowdown, that could indirectly impact Clearwater
How?
by causing a general decline in global financial asset values. And since Clearwater's revenue is linked to client AOP, assets on platform,
If asset values fall, their AOP falls and their revenue takes a hit.
precisely, it's an indirect but still meaningful external threat to monitor.
Conclusion.
Okay, so let's try and pull all this together, synthesize our findings. It feels like Clearwater Analytics is truly at a pivotal moment, doesn't it?
Absolutely. The investment case really boils down to balancing this high-quality core business against some significant, very real, forward-looking execution risk.
Right. So recap the bull case for us.
The bull case is strong. You've got a superior business, fundamentally, with a widening moat that drives high win rates, over 98% gross revenue retention. It's a scalable SaaS model, consistently delivering 20% plus revenue growth, attractive gross margins.
Operating in a great market.
Huge, growing market. Yeah.
Huh.
With powerful secular tailwinds, they've hit that free cash flow inflection point, and management is aggressively executing this clear vision to become an indispensable end-to-end platform.
So if they pull off these integrations successfully.
There's potentially significant long-term value creation ahead. That's the bull thesis.
Okay. Now, the bear case, what does that focus?
Squarely on the immense execution risk. Integrating three large, distinct companies, Infusion, Beacon, Bistro simultaneously is just incredibly difficult.
Failure could mean
Disruption, loss of focus, maybe even value destruction. It's a complex undertaking, and that consistent insider selling we discussed, you could argue it's an implicit acknowledgement of this risk,
yeah,
even if unintended.
and the valuation.
While it seems reasonable against peers, it's still vulnerable. Vulnerable to execution missteps and vulnerable to those macro headwinds like rising interest rates.
So summarizing the valuation picture again, remember those DCF models?
Yeah, that huge range, from a bearish $9.38 per share all the way up to a bullish $42.35 per share.
And the current share price, around $21.30, sits right in the middle of that vast range.
Pretty much. Which implies the market is pricing in some degree of success for their strategy, but it also leaves substantial upside if management executes really well.
So the core investment decision here, it really just hinges on one thing.
Pretty much. It hinges on your confidence as an investor in management's ability to navigate these significant but, well-defined execution risks that lie directly ahead.
A bet on execution.
Largely, yes.
Okay. Before we wrap up, here's a final thought to leave you with. Something to mull over. Given the ever-increasing complexity of global financial markets, global regulations, do you think this single source of truth platform, like Clearwater aims to be, could become not just a competitive advantage, but almost a regulatory necessity for institutions?
Interesting question.
And if so, how might that trend accelerate or maybe even constrain a company like Clearwater in the decades to come? Something to think about.
Definitely food for thought.
All right. If you found this deep dive valuable, maybe consider giving us a like, subscribing to the Stock Analytics AI channel. It really helps us out.
Yeah, and for just $4.50.99 a month, members get priority deep dives on specific tickers. We're actually planning to cover all of the S&P 500 stocks over the next few months.
That's ambitious.
It is, and members get exclusive priority access to those. Or, hey, if you just want a one-off deep dive on a company that's caught your eye, you can always drop us a super thanks.
We appreciate the support.
Absolutely. And please remember, this analysis was generated by an AI system. It's purely for educational purposes. It should absolutely not be considered financial advice.
Please conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Couldn't agree more.